Want to start investing but don't know where to start? You're not alone. Investing is a journey that can lead to financial independence, but it's not a path to tread lightly. It's essential to understand the stock market's intricacies before diving headfirst into this vast financial sea. Why, you ask? Because knowledge is power, and in the world of investing, it's your most valuable asset. Stay tuned as we break down these complexities into simple, easy-to-understand steps. Before you invest, you need to understand what the stock market is. So let's delve into the basics. At its core, the stock market is a marketplace for buying and selling ownership shares in companies, which we call stocks. When you buy a stock, you're essentially buying a small piece of that company, making you a shareholder. There's a myriad of stocks out there, but they all exist on what we call exchanges. These are platforms where stocks are listed and traded. The most famous exchanges are perhaps the New York Stock Exchange and the Nasdaq, but there are many others around the world. Now, when you hear people talking about the market going up or down, they're usually referring to indices. An index is a collection of stocks that represents a particular market or sector. For example, the Dow Jones Industrial Average is an index that includes 30 significant companies traded on the New York Stock Exchange and the Nasdaq. So how does the stock market work? Well, it's all about supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. It's that simple. But why is the stock market so important? For starters, it plays a crucial role in the health of our economy. Companies raise money by selling stocks. This capital helps them grow, create jobs, and contribute to economic growth. On the other hand, the stock market gives individuals like you and me the opportunity to share in the profits of these companies. It's also worth noting that the stock market is a reflection of investor sentiment. It can rise on positive economic news or fall due to global uncertainties. So, keeping an eye on the market can give us valuable insights into broader economic trends. Now that you understand the basics, let's move on to the different strategies you can use. There are various strategies you can employ when investing in the stock market. Let's explore 3 common approaches: buy and hold, dollar cost averaging, and dividend investing. Each of these strategies has its own merits and drawbacks, and understanding them can help tailor an investment approach that fits your financial goals and risk tolerance. First up, buy and hold. As the name suggests, this strategy involves buying stocks and holding onto them for a long period, regardless of market fluctuations. The underlying principle is that, over time, the stock market will provide an average annual return, despite short-term volatility. It's a passive strategy and requires patience. But remember, while history shows us that markets tend to rise over the long term, there are no guarantees. Next, we have dollar cost averaging. This strategy involves investing a fixed amount of money into the stock market at regular intervals, regardless of the price. The idea is to spread out your investments over time, reducing the risk of investing a large amount at the wrong time. It's an excellent strategy for those who wish to invest systematically and reduce the impact of market volatility. However, if the market is consistently rising, you might miss out on some gains. Lastly, dividend investing. This strategy focuses on buying stocks of companies that regularly pay dividends. The dividends can provide a steady income stream, especially useful for those nearing retirement. The potential downside is that these stocks may not have as much growth potential as younger, more aggressive companies that reinvest their profits instead of paying dividends. Each of these strategies comes with its own set of risks and rewards. Your choice should depend on your investment goals, risk tolerance, and investing timeline. Are you investing for long-term growth, or are you looking for a steady income stream? Do you have the patience to weather market volatility, or do you prefer a more systematic approach? Knowing these strategies can help you decide which one fits your investment goals. Investing in the stock market involves risk. Now, that's a line you've probably heard 1,000 times over, but it's worth repeating. Why, you ask? Well, because managing this risk is the key to surviving and thriving in the world of investing. Risk management in investing isn't about avoiding risk entirely. It's about understanding the risks you're taking and making informed decisions to help control them. Think of it as a safety net, something that catches you when the market takes an unexpected tumble. So, how do you manage risk? One way is through diversification. Picture this. You've got a basket full of eggs. If you drop that basket, all your eggs break. But if you spread those eggs across different baskets, the chances of all of them breaking at once get drastically reduced. In investment terms, diversification is about spreading your investments across different types of assets, industries, and geographical regions. This way, if one investment performs poorly, others might perform well and offset the loss. Another strategy is asset allocation. This is the process of dividing your investment portfolio among different asset categories, such as stocks, bonds, and cash. The goal here is to balance risk and reward by adjusting the percentage of each asset in your portfolio according to your risk tolerance, goals, and investment timeframe. For instance, if you're a young investor with a high risk tolerance and a long investment horizon, you might have a higher proportion of stocks in your portfolio. On the other hand, if you're nearing retirement and want to protect your nest egg, you might lean towards safer assets like bonds and cash. Remember, risk isn't inherently bad. In fact, it's often said that with greater risk comes greater reward. But it's essential to understand that reward isn't guaranteed. That's why it's crucial to manage your risk, to ensure that it aligns with your investment goals and risk tolerance. So don't shy away from risk, embrace it, understand it, manage it, and let it work for you. After all, managing risk is crucial in ensuring your investments grow over time. Scene script. Research is a vital component of successful investing. Let's take a moment to consider why. Imagine walking into a library with no idea what book you're looking for. You could end up grabbing anything off the shelf, right? Now, imagine that decision costing you hard-earned money. That's what investing without research is like. It's a gamble, not a strategy. So how can you arm yourself with knowledge? Here's where two crucial concepts come into play: fundamental and technical analysis. Fundamental analysis is like getting to know a company intimately. It's understanding what a company does, its products, its market, its financial health, and its future prospects. It's about diving deep into balance sheets, income statements, and cash flow statements. It's about understanding the company's earnings, its debt levels, and its growth projections. Fundamental analysis helps you answer the question, is this company fundamentally strong and worth investing in? On the other hand, technical analysis is like reading the mood of the market. It's about studying past market data, primarily price and volume. It involves chart patterns, trend lines, and various statistical measures to predict future price movements. Technical analysis helps you answer the question, is now a good time to invest in this stock? Both fundamental and technical analysis are essential. One gives you the what and the why, the other gives you the when. Together they equip you with the tools to make informed investment decisions. But remember, research shouldn't stop once you've made an investment. It's a continuous process. The market is dynamic and things can change rapidly. So, keep tracking your investments, keep learning, and keep adapting. And yes, research can seem daunting, especially when you're just starting out. But the more you do it, the better you'll get at it. And the better you get at it, the more confident you'll become in your investing journey. Remember, investing without research is like driving a car blindfolded. So, take off the blindfold and let research guide your way to successful investing. Investing in the stock market can be a great way to grow your wealth. It's a truth we've navigated through the course of this video, and a principle that continues to hold strong in the world of finance. Let's take a moment to look back at what we've covered. We started by exploring the basics of investing and understanding the stock market. We learned that the stock market is not just a place to buy and sell shares, but a platform that enables companies to raise capital and investors to become part owners of businesses. We then moved on to discussing various stock market strategies. From long-term investing to swing trading, we emphasized the importance of choosing a strategy that aligns with your financial goals and risk tolerance. Next, we delved into the crucial aspect of risk management. Remember, every investment carries a certain level of risk. Knowing how to manage this risk is key to protecting your investment and ensuring steady growth. We also focused on the importance of thorough research before making any investment. By staying informed and understanding the market dynamics, you can make more informed decisions and increase your chances of success. And now, as we wrap up, remember that the journey to becoming a successful investor is not a sprint, but a marathon. It demands patience, consistency, and a commitment to continuous learning. With these tips and strategies, you're now ready to embark on your investment journey. Remember, the key to successful investing is patience and consistency.